Today on Go Ahead Ask, what to buy, what to buy. This is the question. It's one of the most common questions we get from our podcast listeners, especially in today's crazy, hot, fast-paced real estate market. We're going to unravel that question today on Go Ahead Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to the Go Ahead Ask podcast by the Exeter Group, where we unravel the mystery of investment real estate by providing investors with better information, better quality education, so they can make a better informed investment decision. My name is Bill Exeter. I'm Chief Executive Officer of Exeter 1031 Exchange Services and your host today. The Exeter Group of companies includes Exeter 1031 Exchange Services, and we administer all types of 1031 exchanges in all 50 states. And we're one of the few qualified intermediaries that can also administer foreign property 1031 exchange transactions. The Exeter Group of companies also includes Exeter Trust Company, which administers self-directed IRAs where investors want to focus on alternative assets, title holding trust or land trusts where they want to hold real estate confidentially, specialty holding escrows where the typical escrow or title company can't handle it. We can take a look at that, and also kind of specialty custody services. As always here on Go Ahead Ask, we encourage questions, so please feel free to contact us with any question or topic, or if you have an expertise you'd like to appear on Go Ahead Ask, email us at ask@exeterco.com or give us a call at area code 619-239-3091. And if you love Go Ahead Ask, please like it, subscribe to it, share it, and comment on it. We will respond to all of the comments posted. Today's topic is unraveling the mystery of net lease versus multi-unit investment real estate. And as I said before, one of the most common questions we get from our podcast listeners today is what to buy in this crazy, fast-paced real estate market that we're in. What type of investment property? Should I buy single family? Should I buy multifamily? Should I get in a commercial office or retail or industrial? Should I go with active property management or should I go with passive property management, such as what we're talking about today, like net lease properties, the syndicated tenant-in-common investment properties, or the Delaware Statutory Trusts? So we're going to unravel that mystery today on Go Ahead Ask. And we're lucky to have actually two experts with us today on Go Ahead Ask. Our first expert is Mike Bertelson, and Mike is an agent with Vandermeulen Investment Properties, a firm that specializes in all aspects of commercial real estate sales. He's been bringing buyers and sellers together since 2012 as a home and commercial real estate specialist. Mike, welcome to the show today.
Hey, Bill, thanks for having me.
My pleasure, absolutely. Our second expert is Brian Poor, who's also with Vandermeulen Investment Properties, and he's got over a decade of real estate experience in real estate sales. He's assisted sellers and with relocating, up and downsizing, short sales, and 1031 exchanges. So, Brian, welcome to the show as well.
Yeah, thank you for having me. We're excited to be here.
And I love your taglines, the Mike and Brian, the triple net guys. That's fantastic. Very catchy and right into the point.
Exactly.
So, Mike,
yeah, we kind of took a play from the.
Oh, sorry. Go ahead.
Oh, we kind of took a play from the Mark and Brian radio show a while back. Some people remember it.
Absolutely. Yeah, it's funny how some people remember those, and other people they look at you like, "What are you talking about?"
Yeah.
Well, Mike, maybe tell us a little more about Vandermeulen Investment Properties and what the firm specializes in.
Yeah, absolutely. So Vandermeulen Investment Properties, the entity itself is fairly new, about 3 or 4 years old, but the broker has been doing this kind of commercial property sales for over 10 years. So I joined the company before it was Vandermeulen Investment Properties, actually, and jumped across when they started their own entity. We're a boutique firm, and we specialize in helping people sell generally multi-unit properties, people that are tired of dealing with tenants, doing repairs, all the work that goes into managing a multi-unit property, and help them exchange into a triple net property with little to no landlord responsibilities.
And Brian, let's get a little personal first, if I can. So maybe give us an idea of what you would like listeners to know about you.
I've been in the business for coming up on 13 years. I started out on the residential end, and just always kind of been intrigued on more on the investment side. And I was talking with Mike, about a year before I made a switch. I've been with the company about about 3.5 years. So it's fun. I'm a numbers guy, and this is pretty much all numbers. There's not a lot of emotion when buying this stuff, so makes it fun.
Excellent. Mike, same question. What would listeners want to know about you?
Much like Brian, I'm a numbers guy. So I'm very logical. So when people are looking for investments, I'm so much better with numbers than I think I was pretty good with the houses too, but I think I'm a lot better with the numbers than I was with the emotional factor of residential property. Other than that, me and Brian, we work together. I'm the background. I'm in the background. I'm doing the research. I'm looking stuff up and everything. Where Brian's out there hitting the phones and and doing that side of it. So we work really well together because we both complement each other's weaknesses.
Excellent. And that's probably one of the things we'll talk about today is that the single family market is probably driven much more by emotion, where the multifamily and commercial markets are probably much more technical driven, numbers driven, as opposed to emotional. So with that, let's go ahead and start unraveling the mystery of net lease versus multi-unit investment properties. And I thought I'd set the stage because part of what we're going into kind of falls into two categories in the 1031 exchange world. One is qualified use, what satisfies the qualified use requirement. And second, what satisfies the like kind requirement. So I'm going to go in reverse order. A lot of folks out there still think like kind means condo for condo, apartments for apartments, of course, and that's not true. Like kind literally means you're selling real estate and you have to buy real estate. So there's a very broad category of what qualifies as like kind property. It even includes things like air rights, water rights, mineral rights, certain types of oil and gas, et cetera. So it gives you a great ability to reposition your real estate portfolio depending on what's right for you. The second area is probably where there's the most confusion out there, and that's the qualified use requirement. And that just means that whatever you're selling and then whatever you buy through the 1031 exchange has to be held for qualified use, which is some type of rental, investment, or business use. If you're in the business of buying the real estate and you're developing it, you're building it, you're rehabbing it, or you're converting it into selling, you're really holding for sale and it doesn't qualify for 1031 exchange treatment. But if you buy and you do any of those, develop, build, rehab, convert, or even just buy to hold, and your intent is to hold for investment, hold for rental, or hold for business use, it will qualify for 1031 exchange. So keep that in mind as we're going through this, that this is a very broad area that allows you to really reposition your portfolio based on what your goals and objectives are. So as we're going through the program today, if you have any follow-up questions you'd like to ask, go ahead and post it in the comments section of your social media program, and we'll go ahead and respond to that as we see them. So Mike, why don't we start off with kind of a high-level discussion of kind of, first of all, what is active management real estate versus passive management real estate, and why would an investor go one way or the other?
Sure. So we'll start off with telling what both are. Active property management would be you would have to hire somebody to actively manage the property on a probably a month-to-month, day-to-day basis. So there's a lot more work involved for either you as the landlord would have to do this, and this takes a lot of time, or you would have to hire a property management company, and that would cut into your cash flow. As far as passive, it's exactly the opposite. As far as triple net goes, they're very passive. The tenant will take care of all these issues for you, so you wouldn't have to do anything. You could, people literally sit at home and get a check every month in the mail from these kind of properties.
And that could be a huge decision. I think a lot of people start off on the active side, and then they get to the point where they're tired of property management, or what people refer to as the terrible T's.
Yeah, we say that. We say, get rid of the 3 T's and move over to the 3 N's. Tenants, toilets, and what's the third?
Termites.
There you go.
Or it gets worse and worse. We throw in toddlers, teenagers, and on and on and on and on. And I had somebody the other day bring up a T, and now I can't think what it was, but there was a whole different one that I thought, wow, we never thought of that before. So
it can be a lot of things. You can make it anything you want.
Really. That's absolutely right. It's a lot of things.
Just you can say trouble, trouble, and trouble.
So absolutely true. So Brian, why would an investor want to buy something maybe closer to home or going further away from home, or maybe even out of state? So when you're looking at active versus passive, and then you kind of go into, do I buy close to home or do I buy farther away? What are your thoughts?
Yeah, a lot of people, when it comes to active, they want something close by, which limits where they're at, and where they're at really is price dependent. I mean, our office is in Newport Beach. Price levels are really high, and a lot of people that are active want to be within an hour or two to drive by the property, check on it, maybe see if the tenants, the quality of the property and everything. Whereas passive, we sell stuff nationwide. So with you not having to worry about driving by the property and checking on it, because your tenant's responsible for, maintenance and insurance and all taxes and everything on the property, it allows them to buy properties anywhere across the United States.
And Mike, let's dive into kind of a comparative conversation on net lease properties versus multi-tenant, which multi-tenant is probably more active management versus the net lease properties that you guys focus on.
Yeah, absolutely. So, most of our clients are generally a little bit older, and they've had these active management properties for a long time, and they're just done. Either they're doing estate planning and their children don't want to have to do this, so they don't even want this property when the time comes. So they will exchange into one of these passive ones where they just get a check every month. The kids don't have to manage anything. The people don't have to manage anything anymore. I know when I'm getting up there in age, I don't want to have to go and try to find new tenants and repair a leak in one of the bathrooms and all these things that come along with the active property management as far as multi-unit goes. So that would be the biggest difference. It's just, do you want to have that possible sweat equity and do it yourself, or do you want to just sit back and collect the check every month? And most of our clients just want to sit back and collect the check every month.
As you were talking, I was thinking of another podcast I happened to be watching a few weeks ago, and they were kind of showing basically the terrible T's. And there was this one where they had ripped the carpet up, and there were amazing how many stains under that. And the citation of the quote was, "What dog?"
Exactly.
And then he joked and said, "I think we're going to change this from what dog to wet dog, because man, that dog must have drank a lot of water." And that's exactly why some people just want to get out of that. It's amazing what kind of stuff you see on the active management side.
Absolutely. And another thing I could add to that is a lot of our clients that sell their multifamilies tell us, oh yeah, I have a 7% cap rate on my property. But when we dig into their financials and see what they're actually paying every month for everything, they're usually a lot lower as a cap rate than what they think they're actually getting. So that's another thing we do, dig in and show them what their cap rate really is.
So with the 7%, that's probably their top level total revenue as a percentage of the property, and not their net.
Exactly. I had a client who I sold, over $4 million apartment building, and they were probably at a 2% cap rate with all their expenses. But they were telling me that, no, we're at 6%. We're making great money. But once we dig in, you can see the truth of what returns really are.
No, like you said, it's a numbers game. It's just about crunching the numbers and finding out exactly where you're at. Exactly. I also see a lot of investors who calculate what their either gross or net income is, and then divide it into their original cost basis to see their return. And that original cost basis could be 20, 30, 40 years ago, instead of basing it on today's market value to see what their return is on what their asset is worth today. And a lot of investors, they'll call us and they say, I own dirt, and of course it doesn't produce any income and no cash flow whatsoever. Or maybe they lease it to a farmer, so they're getting some kind of grazing rights or something like that. But the land is really a non-performing asset almost. It may go up in value, but there's no cash flow. So we get folks that call in all the time and say, I've got land, but what the heck can I do with that if I sell it? And so that's kind of where we've had a couple people, email in on the podcast and say, can I sell land for other type of real estate? Which the answer is yes, of course. Land is certainly held for investment. And if you reinvest in something else, it's also held for rental, investment, or business use. So it would satisfy the qualified use, and it would also satisfy the like kind requirement. But maybe kind of speak to what they would get if they sold land and maybe exchanged into a net lease asset.
In comparisons to land and triple net, it's almost the same thing. It sits there, but the difference between land and a triple net asset is you're producing income. You own the land, you own the building, and you're buying the lease ultimately. So with that, at least you're producing an income. The tenant's taking care of the taxes, insurance, and maintenance of the property. So with land, it's sitting there. You don't really have to worry about too much, maybe some weed abatements. You could roll that over into a triple net and still get, a property you don't really have to do anything with, but you're actually producing some income with it.
And you mentioned weed abatement. That's a good point, because here in California, with all the, in many cases, crazy new laws and regulations, you have to be on top of that. Otherwise, you can rack up some pretty significant penalties if you don't do the right weed abatement and clear your property for, kind of a wildfire management purposes.
Yeah, it's one of those things that, depending on where you're at, you get hit. You still have to manage the property. So there's a cost associated with that. You're paying taxes. You don't really have any income coming in unless like you said, you're leasing it or something, or leasing it to a trucking company, parking their trucks. There's some things you could do with land, but it'd be more of an active investment than a triple net asset.
So true. We're going to take a quick commercial break for a message from our sponsor. This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750 or visit them on the internet at exetertrustcompany.net. And we're back with Mike and Brian, the Triple Net guys. We're going to expand upon unraveling the mystery of net lease versus multi-unit investment properties. So with that, why don't we get into, Mike, what kind of tenants can an investor expect to see with net lease properties? And maybe what should they look for in a tenant as well?
Well, it obviously depends on the amount of money that you have to spend, what kind of tenants you're going to get. But you can get anything from a mom and pop flower store to Amazon if you want. So SpaceX, anything you want. They're generally out there leasing something. So most of our clients, we like to get them quality companies, publicly traded companies we like because they're safer. Their leases are corporate backed, so if they ever do leave, if they're still going to pay the rent. They're public, so you see their financials every single year, so you know they're safe. So most of our clients, we like to get BBB rated or better tenants, so that that's investment grade properties. So that way we know we never know, but we're a better likelihood that they're going to stay and they're going to pay their rent every month. So, but anything from McDonald's to CVS to Starbucks, you name it, you can get it.
In fact, that's a good point between corporate versus non-corporate. We had an individual a few weeks ago that we were just chatting with, and he thought his was corporate backed because there was an individual who set up an LLC and owned, I think it was like 20 of the net lease assets, and it was the same company or same tenant, but it wasn't the corporate backing, it was his LLC that backed it. So maybe speak to what that means. What is corporate versus non-corporate?
Yeah, sure. So corporate back would, let's say, for example, a CVS pharmacy, someone buys a CVS pharmacy. It's owned by the CVS, the corporation itself. It's not owned by a franchisee. So fast food, for example, a lot of them are franchisees. So if you just buy a McDonald's, that person might only own that one McDonald's, and they're private and they do not share their financials. So you don't know how well they're doing. That's why we like the corporate backed one, because you can see exactly how they're doing. And and another thing, we always tell our clients, if they buy something like that, buy one stock in that company, because every year you're going to get their reports. You're going to know exactly how well this company is doing, and there's going to be no surprises. The only surprise I can think of in recent history is 24-Hour Fitness. When COVID hit, they filed bankruptcy, and when they filed bankruptcy, they closed quite a few of their gyms. And unfortunately, since they did file bankruptcy, the people that own those properties, they're not going to get the rent anymore. But that's an anomaly that doesn't generally happen. And obviously, that was a shock to everybody, the pandemic that did it for them. But it doesn't happen too often where one of those big companies files bankruptcy like that.
That would be certainly a shock. I think they had something along that line well before. It was back in the '08 recession too, where Starbucks all of a sudden decided to close a number of their locations as well. But that's just one of the risks that we have, where stuff does happen.
Yes, it does, but that doesn't happen often. So we don't count on that happening. We always obviously let them know it could happen, but the likelihood of it is very low, especially with these essential businesses, as we call them now, that didn't close during COVID. So even if something else happens again, they're probably still going to be open, like the pharmacies and the supermarkets and the dollar stores. They were open the whole time, and they thrived.
How are the properties priced? How are they valued? And kind of the dynamics behind that.
Well, I mean, when it comes to the triple net, I mean, there's nothing too tricky about it. There's a lease. The income's already set in there. It's already stated what they're doing for taxes and everything. So your income's in there, and you just calculate the net income. And really, when you're coming to a triple net property, it's all cap rate based. They're all buying based upon the cap rate. And the cap rate's a little more stable when you're looking at a triple net than a multi-unit, just because all the capital expenditures fluctuate and everything in there.
I'm going to kind of expand on that. So when they're looking at properties and they're crunching the numbers, et cetera, what else would come into play besides the numbers as to how they would choose, how they would choose the tenant, how they would choose the location? What else do you kind of look at there?
I mean, demographics are always important. I mean, at the end of the day, with the triple net, I mean, the tenant does have a lease with you, but if they weren't to renew, you do have a building. So demographics come into play, and a lot of the essential businesses, like we like dollar stores because it's just a rectangle box. So for some reason down the road, re-renting that out is no problem. So demographics is a big play. Prices have changed quite a bit to get actually a good location. Cap rates are going down a little bit on them. And it's getting a little pricey to get into a good area. But I mean, there's a lot of outskirts, and a lot of our tenants that we're looking at, they strive in those demographics too. Like dollar stores, they don't, they do really good with the lower demographics, but not too low.
Good to know. I guess that's always the risk, is what if they don't renew? But that's a perfect example where you got the right demographics, you can easily convert the building to some other usage.
Exactly. And we even look at things as far as demographics go. We even look at if the population is growing or declining, because we don't want to sell something in a declining population area, because obviously less people over time is going to make it harder to lease that out down the road or sell it down the road, either way.
And kind of, Mike, the next kind of thought from that, I guess, would be how often can you raise rents on the tenants? Can you raise the rents on the tenants? What might be built into the leases?
Yeah, a simple answer, no. The leases are pretty solid. They say exactly what they mean. They say exactly what the rent's going to be and when it's going to happen. They do often have rent bumps in them on 5 or 10 year increments. If there are options after the initial lease, there's generally bumps there, but I'm actually seeing less and less bumps as the year goes on. So certain places that usually did, like for example, Dollar General, I'm seeing their new stores 15 years flat rate. They used to do bumps every 5 years. So the structures are changing, but they are all locked in the lease. There are potential to renegotiate leases towards the end. It's somewhat common, but not too common. But it just depends on if the tenant wants to and if the owner wants to. So it's possible, but not likely.
So almost very, assuming nothing goes wrong, very predictable cash flow. It just kind of happens. However, they tell you what they're going to pay and very little bumps, if any.
Exactly. Yeah. I mean, the bumps are going away. It's just because they can, I think, is the reason they're doing it. So it's kind of tough though when you buy something today and you have a flat rent for 15 years. Like in 12 years, with inflation and with cost of everything else, you're gonna have to, it's hard to know what's gonna happen in that long of a time. So it's kind of hard for some people. Like CVS will do 25 years flat, and that's hard just pill to swallow for some people. But CVS is probably going to be there in 25 years, so that you have the safety of that. So it's kind of you got to weigh out your options and see if it works for you.
Yeah, we've always had a lot of exchange clients that have said, it kind of touched on that point and said, well, I am looking at this point in my life for predictable cash flow, and if it doesn't completely keep up with inflation, that's okay. I know what I'm going to get. I know what to expect, and they're going to be around. So that's what I'm buying into.
Exactly.
It's kind of like coupon clipping. It's, back in the old days when you bought a bond and you had the coupons attached, you clip off the coupon and you cash it in, and kind of the same concept almost.
Yeah, pretty similar. You know what you're getting.
And then Brian, if they go into net lease properties, do they need a property manager? Do they have to arrange for insurance? Kind of all those other things that come into play when you buy real estate.
Well, we always suggest the client to get an additional insurance policy on the property just to cover themselves. But the tenant, no. I mean, they're managing the property themselves. They're responsible for the maintenance. Now, sometimes there are situations where there's a double net property and you are responsible for like a roof and structure. But again, that's all in the lease. So there's really no need for a property manager because the tenant's already taking care of everything themselves. But we do suggest a client to get a personal insurance on the property just as a backup.
And is the personal insurance, is that property and casualty for casualty losses, or is that more for liability purposes?
So I would say more for liability, just kind of like an umbrella, just to cover just in case. I mean, you're going to see in the leases exactly what kind of insurance the tenant has to have. It'll be written in there, so you know exactly what they have, and they're going to do the maintenance because they have an image to uphold, so they're going to keep it clean and maintained because of their image. So it's not for the landlord specifically; it's more for themselves, but it also helps the landlord out when they do like that. So so that's what I would say about that.
And I guess for all the last kind of topics we've covered, it also depends on whether it's truly a corporate, or if you get a mom and pop type shop, then you've got more to worry about, more to kind of watch over them just to make sure they're keeping up with what they're supposed to do.
Yeah, that'd be true, absolutely, because the big corporate ones will have generally a regional office that pretty much manages their properties for them. So they'll have their own built-in property management for the most part. But yeah, the mom and pops might not keep it as clean. In a single tenant one, you would hope they would, because obviously they want their image to look good too. They don't want to be known as the messy or the dirty property in the area either. So hopefully they want to do it too, though.
Brian, what happens if we do the investment, they get into the new triple net property, and the tenant, for whatever reason, doesn't pay, they fail, whether it's maybe an 2008 recession or COVID-19, like the 24-hour fitness?
Yeah, unfortunately, Mike, you want to actually answer that one?
Yeah, well, but the 2019 with the COVID thing, that was there's really not much anybody could do because of the federal moratorium for getting rid of anybody. Unfortunately, landlords couldn't do anything about that. I didn't have any clients who had any non-corporate properties, so it wasn't really an issue. I did have one client who had trouble with a tenant not reimbursing them in the timely manner. So they actually had to, unfortunately, get a lawyer to handle all that for them. But that I've never heard that before. This is the first time I've heard of them not paying reimbursing. It was for property taxes. So in this one, the owner would pay the property taxes and the tenant would reimburse them. And in the lease, they have 30 days to do it, and they didn't get it to them in 30 days. So you might have to get a lawyer if something like that were to happen, but it generally doesn't happen. They usually do it.
Got it. And I guess worst case, if like in the 24-hour or fitness, if they truly went under, filed bankruptcy and didn't survive or closed that particular location, then I guess worst case, you end up with real estate. You own the real estate. It's just a matter of trying to figure out what you're going to repurpose and do with the property. And then, Brian, with if an investor's trying to decide what to do, what to reinvest in, there's other options that they might be looking at as well. So maybe can you compare and contrast kind of a net lease property versus something that might be like a TIC, a tenant-in-common investment property versus like a Delaware Statutory Trust, and what your thoughts are on that?
Yeah, I mean, the DSTs are definitely one of our biggest competitors because you could exchange from one property into a DST. So a lot of people see it as a low maintenance. It's something they could go put money in, and the DST buys something using their money. They're getting a pretty decent return on it, but ultimately they have no control over the property at all. If the DST comes to you one morning and says, we're selling, then you have to reposition yourself to go and do an exchange and get into something else. Whereas something on a triple net aspect, you're in full control. If you get to a point 5 years down the road and you want to go from a dollar store to a CVS, you're more than capable of doing it at your own pace and whatnot. Whereas you just don't have any control over a DST and what they're doing.
Probably taking that a little further too, when you say control. So obviously if you bought a net lease property too, if you wanted to refinance, you could do that. If you wanted to sell it, you could do that because you really have 100% ownership, 100% control.
Exactly.
And then kind of the final question, we always want to talk about pros and cons, et cetera. So Mike, maybe what are the risks with a net lease property? What should an investor need to be aware of?
To me, the biggest risk would honestly be financing. Because financing for commercial loans is much different than, you don't get a 30-year fixed on a commercial loan. It's just not how it works. A lot of new investors don't know that. So when you buy a commercial triple net property, you're going to get a 5, 7, or 10-year note generally. It can be amortized over 25 or 30 years, so your payments will be like a 30-year payment, but you're going to have to refinance it. But if you get something with 15 years left on it, let's say you get a 7-year note, and in 7 years you're going to have to refinance or sell or do something. Let's say you bought something with 10 years with a 7-year note. When that's up, you only have 3 years left. It's going to be difficult to refinance. You might not be able to, because most lenders are going to want to have their note only as long as the guaranteed lease is left. So that would be the biggest biggest risk, I would say, as far as triple net is the financing issue if you don't have enough time left on the lease to refinance it.
And certainly in today's world, we're looking at interest rates that are phenomenally low. So really interest rates only have one way to go. And with all the discussion of inflation and things like that, certainly owning real estate in an inflationary environment is phenomenal because the values will go up in theory. But as interest rates go up too, that's going to feed right into what you just talked about.
Mm-hmm, exactly. So that would be that is the biggest issue that I like to tell people, because especially new people, if they've never done commercial investing before, that is a big thing. I don't like to get too deep into it since I'm not a commercial lender, but I like to just give the basics, and then I point them to a lender to talk to get to the really deep questions about it.
Well, and the challenge is underwriting requirements, including interest rates, are changing all the time. So even if you know what it is, next month they completely change. You never know. So that is always a moving target.
Yeah, and with COVID, I mean, the down payment requirements went up on everything. Before you could do something for possibly 25, 30%. Now some places they want a minimum 40%. It just depends. And another thing about the loans is they are very specific to the property. You don't just say I'm buying a house in the city and they know. No, it's specific to this property, the tenant, everything comes into effect with the commercial loans.
Certainly a moving target there.
Yes, yeah, absolutely.
Brian and Mike, any follow-up or final comments that you want to throw out there? Any little educational tidbits?
As with everything, there's pros and cons to triple net property investing. The big thing I would say is you're buying the cash flow. That's the main thing. Yes, you do get the land and the building, but the big deal is the cash flow. So as long as, I think if you're just looking for the cash flow and it makes sense to you and you like the passive aspect of it, I think is a great investment. Us being in California, everyone wants, oh, California, property values are always going up and this, and I agree. You can buy a Starbucks here in California if you really want to, and the property value will go up over time, most likely. I can't say that 100%, obviously, but your cap rate is going to be 3.5%. Or you can go buy a Starbucks somewhere further east and get a 5% cap rate. So it all depends on your investing strategy. If you have the money and you're looking long term, yeah, California's great for sure. But if you're just looking for cash flow right now, I don't believe that California is the place to do it.
And Brian, any follow-up from you?
So yeah, I think one of the biggest tips coming in right now is the world has really changed over the past year and a half. It's really allowed a lot of people to really evaluate where they want to be. A lot of people are working from home. There's really good investments all over the place. I mean, we got hot spots like Atlanta, Louisiana, the Gulf Coast, East Coast. A lot of these communities are striving. I mean, a lot of big businesses are going there. And even though a lot of the tenants are being pushed out and prices are going up, the demos, those areas are going to grow, which really excels in, some good appreciation down the road. I mean, there's some really hot markets. A lot of our people love Tennessee, Georgia, the whole Gulf, Florida. Florida's been huge. I mean, a lot of people are looking at Florida. So, I think there's some really big appreciation to be had for some of these tenants. And we stick to a lot of buildings that are new, that are safe. So that's just something to kind of keep in mind. You don't have to buy next to you. A lot of our clients actually like buying in a place that they have family or want to visit, which then it's a write-off. So if you're from or have family in Connecticut, they like buying a building out there. That way, when they go visit, it's a write-off, and then they could go buy and check on their building. So the biggest tidbit to take away is don't limit yourself on where you want to be with these investments, because there is not really a lot of a responsibility you have to worry about at all. Now, some of them, yes. I mean, we do extend from, value add strip malls to very solid triple net clients. So we do work with a wide range, but, a lot of opportunity out there.
Especially in the California marketplace with everything that's happened here, the politics, the rent controls, the eviction moratoriums, there's all sorts of people who are going, I'm just done. I want to get out.
I got a lot of friends that are leaving the state. It's a great place. Appreciation's going to be there, but it is a great place. But there's a lot of opportunities all over the place. I think more than ever now.
Yeah, the challenge is California and some of the politics that have come out and recent legislation has added risk to the equation. As long as you can manage the risk and understand it and deal with it, then you're probably okay. But you have to be willing to do that. There's just been so many surprises that investors are, we have a lot of clients exchanging out of California just because they don't want the surprises anymore.
Yeah,
absolutely.
It's not a good time to be a landlord in California. I mean, there's so many restrictions, and so you're pretty much powerless to the tenant, unfortunately. So that is one of the reasons people are selling in California and buying out of state.
Yeah, and to an extent, with the multi-units, there's a lot of pain for a lot of people. I mean, it's been a long time that people didn't collect rent, all the heartache and falling behind, and I mean, there's a lot of things that really change the dynamics. And we went from dealing with a lot of older clients to a lot of younger clients that just see the potential in these deals and a good place to put money and not have to worry about, tenants not paying and stuff like that, which has been a big one over the past year and a half.
It's just amazing how the dynamics has changed in the last 2 years because of COVID. So that creates a lot of issues. And we may have listeners who want to follow up with you guys. So maybe, Mike, why don't we start with you? How can listeners get in touch with you if they want to follow up or have questions, etc.?
Yeah, absolutely. Well, they can email me at mike@vipinvestmentre.com. And they can give me a call or text anytime with questions at 714-488-8975.
And Brian, same for you. Why don't you give out your contact info?
Yeah, my email is the same as it's Brian at VIPinvestmentre.com. And then my cell phone is 714-600-2577. You can find me. I'm mainly on Instagram too. It's the Poor Real Estate Guy. It's and then PORE Real Estate Guy.
Perfect. Thank you, guys. We have been talking with Mike and Brian, the Triple Net guys, and discussing and unraveling the mystery of net lease properties versus multi-unit investment properties. So that was a lot of great information. Thank you both for being on the show today. We very much appreciate that.
Of course. Thank you for having us.
Yeah. Thanks for having us. Thanks for
You're welcome. My pleasure. Absolutely. Thank you for listening to Go Ahead Ask podcast today. We very much appreciate your subscriptions and interest in our podcast. The last couple episodes we've kind of given an update on the tax policy proposals or proposed tax policy changes. So if you want to listen to the last couple ones just to kind of get a feeling for where the tax policy changes are going. If you like Go Ahead Ask or love Go Ahead Ask podcast, please share it, like it, subscribe to it, and comment on it. We will respond to all of the comments out there. As always, we encourage questions, topics, or if you even want to appear on Go Ahead Ask, send us an email to ask@exeterco.com or give us a call at area code 619-239-3091. Again, thank you for joining us today. We look forward to seeing you next time.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.